Good morning, everybody from Hawaii. Just giving you a video on tokenization. This is one that has come up a lot in questions, kind of through email and also kind of through other avenues of really just the basics of wrapping your head around this. So there's a lot of different ways to explain tokenization. You know, it could be through ID or data farming or finance or art, et cetera, et cetera. I'm going to use real estate as an example, as a simple example, I should say. And then any other tokenization videos that I do, or maybe you come across, kind of use real estate as a leap off point when wrapping your head around other assets that can be tokenized. So I'm going to get out my whiteboard on OneNote. Give me a second. So share my screen. And I'm going to go over real estate as this is simple numbers because I know houses these days don't cost only $100,000, but I want you to just use this as a simple example to start with. And I'll go over the old system versus the new system, where on the old system, you're going to a bank to get a mortgage, and then you're paying interest rate on that mortgage. And then eventually in 15 years or 30 years, whatever the terms are, you can have the house in clear and have the deed full. Also, just keeping to think about this, let's say you have $100,000 that you bought in cash and you didn't go the mortgage system, then you'd have $100K in equity. And usually what the banks will do is you can establish a line of credit or even a loan from that bank. And it's usually, 3% to 7% or whatever the interest rates are going for at that point. The question that comes up is if it's really equity and it's yours because it's your home, why do you have to borrow against it from a bank? And what we're looking at doing with tokenization on this new system, if you look at it from a standpoint of, let's suppose every dollar of that equity, the 100,000, you can tokenize into tokens that equal $1 each. Well, then it would stand to reason that you now have 100,000 tokens that represent the equity in your home. The new system, at least from a standpoint of, okay, if I have 100,000 in tokens and equity, and I want to, I don't know, buy a new truck or something, you can sell, 30,000 of those tokens, let's say to a rich uncle, or maybe a rich confidant or coworker or business partner. Jesus, this thing sucks. A rich uncle. And then now you have $30,000 in cash. That is equity that you've just easily tapped into because you've been able to tokenize it, sell it onto an open market, sell it to a friend. You can crowdsource it. Who knows, what future systems will be built up for this and what applications you'll be able to use. But the purpose of it is that you have, full control of your equity tokens accordingly. And let's say that, well, what happens if the house is worth in this year, 2025, it's worth 100K. How real estate goes, let's say in 5 years, 2030, the house is now worth 200K. Well, now you have 200,000 tokens as long as you didn't sell any off to buy a new truck or do anything that you want to do with cash in hand. What this is doing is taking something that's kind of abstract, which is equity, and then making it tangible, which is where the tokenization process comes in. Simple example, and I get that, but the purpose of it is to kind of illustrate what you can do with tokenizing equity in a home. And that's something that we're used to because the old system and I should say the old system, but the current system that we're using now allows you to tap into that, but they do it at a price. Where what you're doing on the new system is that you're controlling the price and you can sell that equity to do whatever you choose or to a willing buyer pretty much anywhere around the world. You don't even have to deal with those in your own country or your own geographical area. You can use this as almost like a crowdsourcing thing if you want. You want to sell 30,000 tokens, maybe find six people who purchase 5,000 tokens each. Some people with money to spend and invest want to invest in an equity system that will show a rate of return. If they're buying a piece of $100,000 house in a nice neighborhood, let's say, and they expect it to go to 2,000, their share of those tokens that were bought from them also would go up as well. Simple way to wrap your head around it, but that's kind of the theory behind it. Now let's take a look into how this could work also with mortgages as well. Same thing. You have a $100,000 home, and from that $100,000 home, let's say you put 30,000 down and you mortgage 70 grand. Well, for a 70 grand mortgage, if you spread it out to 30 years, the mortgage will be about 334 a month. 234 of that will be paid in interest. $100 of that will be paid in principal. And you're already starting out with 30,000 tokens. And every time you make a mortgage payment that pays part of that principal down, you're just adding 100 more tokens to your stockpile of equity tokens, let's say. So now you have 30,100 tokens after that first interest payment. Second interest payment, paying 334 again. But now the interest is only 233 a month. And now the principal is 101. So as soon as you make that mortgage payment, now you have an extra 101 tokens to your equity pool. So the principal, when you're paying that down, the more you pay down on the principal, the more equity tokens that you will earn. Take it, 12 months later, let's say on the 12th month, you're still paying 334 for your mortgage each month, but now you're only paying 229 in interest, and now you're receiving 105 equity tokens into your home. Same thing in month 13, 334 a month. That doesn't change. Now the interest is only 228, and you just paid down $106 on your principal. So now you have 106 tokens, so on and so on and so forth. So as the interest payments go down, what you're putting into the principal goes up. It's a typical mortgage. Your equity tokens increase by whatever you pay down that principal. That's pretty much the thought and the gist of it. And you may have, let's say it's not even a bank that you get this mortgage from. You may have companies built on blockchains that have real estate equity pools that you can borrow that 70,000 from. And on the app for that blockchain built company, you'll see tabs with mortgage, interest, principal, and it shows you what your tokens are, maybe secured in a non-custodial wallet that you have of your own making. So 106 tokens go into your non-custodial wallet every time you get down to that point. We're not sure how the future is going to look with this, but this is just a kind of a bird's eye view and a peering over what could be possible if these, let's say, tokenized real estate equity pools get built on various blockchains. Who knows which blockchain it's going to be built on? We're not able to see the future there, but we can probably take our guess if certain companies are talking about, hey, we'd really like to do this in the real estate market because of the amount of equity that's available. A lot of money out there and a lot of opportunity out there for entrepreneurs who are going to be doing this stuff. So now let's take it into a different realm. Let's take it to where maybe you want to upgrade your home, bathroom, master bedroom to rent it out as an Airbnb, and you've paid full in cash $100,000 for your home, and you've got this little master bedroom, master bathroom area that you want to upgrade so you can generate revenue as people normally do with Airbnb, right? So with that being in mind, you can kind of do the same thing here too. Let's say you want to sell 20,000 tokens on an open market. Now you're upgrading the bathroom, you're upgrading the bedroom, now you're putting on Airbnb and you're renting it out. But for the person who buys the 20,000, you're offering, let's say, a rate of return. let's say you end up getting $5,000 a month from your Airbnb, and those 20,000 tokens that person bought is going to get, I don't know, a 20% rate of return. Who knows? This open market, so the interest rates can vary on what the return would be getting. So if you're the person who buys the 20,000 tokens for this Airbnb upgrade, you'd be receiving $1,000 a month in interest payments, because that would be the purpose of you investing in something like that. One, it's the equity in the home in case the home price goes up, but this person is turning their home into an asset for monthly cash flow. Maybe you're buying the tokens for that reason, to get that monthly cash flow. And maybe the owner and yourself who say, look, the owner is going to do this for 5 years. So you build it into the contract, not just to pay them $1,000 a month from your Airbnb money and revenue that you're bringing in, but say you're going to pay, 300 to 500 extra each month to get back your tokens. So you as a homeowner are lending out the 20,000 tokens, but you want them back in 5 years' time. So you pay a little bit extra on top of that 1,000. So you can basically have the Airbnb pay for that equity back. And then, now you're paying 1,500 a month out of the 5,000. You're netting 3,500 a month for cash flow. You do that with 2 or 3 homes, you're talking about $10,000 a month that's coming in just from your own homes and the equity that you have in them. So it's a way for people to bring in extra cash flow, and also to control it in a lot of ways, because when you just have intangible equity out there, you have to go with your hat in hand begging and borrowing banks to get money based on that equity, and then upgrade, and then pay the bank back. Here, you're actually opening up markets to other people that can make microtransactions. 20,000 people maybe buy $1 token each. You can do it that way, crowdsource it if you want to, the equity in your home. With our current system, we can't do that right now, but that's the thought behind it, and the reason why people are talking about not just real estate as a tokenization option, but other assets as well, and probably more tangible ones than just the concept of equity in a home. So final thoughts on this. The beauty of this is that you're not dependent on banks anymore, and you're not going, begging to banks for a certain amount of money so you can upgrade your bathroom, so you can get an Airbnb going. Not what you're into. The other side of it, it also cuts out this whole creditworthiness, credit score, and maybe even traditional underwriting that banks usually use and mortgage companies usually use when they're lending out money. You're basically not dependent on your creditworthiness, but you're depending on the risk that an investor who's buying 20,000 tokens is going to take. So what you're talking about here is investors are going to be risking that 20 grand in tokens based on the shape of the home, whether you upkeep the home, whether it increases in value from the market price. They would be the ones taking on the risk instead of the banks. And every investor has their own little profile of what they're willing to take on as far as risk is concerned. And banks do as well. The banks also have a lot of us by the balls, because they're the ones we usually go to with this type of arrangement in order to tap into equity. You don't have to do that anymore. Now, the other side to it is, you probably heard a lot of elderly people talking about when they get to a certain age to do a reverse mortgage on their home. And by doing a reverse mortgage, again, you're going through the bank, and the bank is paying the elderly couple X amount of dollars a month for cash flow, because things are more expensive when you're on a fixed income. And then by the time the couple passes away, the bank gets the house. That's kind of the way it works. With this, you can actually give it out to, let's say you have 100,000 tokens and you have 4 children. You could actually split it up, 25,000 tokens per child, and maybe the children of the elderly couple can be paying their parents for the equity in the home, so it would actually stay in the family instead of actually going to the bank in a reverse mortgage. Same concept, but tokenization allows a little more flexibility a lot more flexibility, if you want to be honest about this, with people who don't have to go that reverse mortgage route, and then they keep the home in the family. Each child has 25,000 tokens. They can agree to buy each other out from the tokens on a payment plan, or give it to their own children for grandchildren, nieces and nephews, whoever it may be, to pass this kind of equity on as time goes on, so the banks aren't keeping all the properties that we're actually living in and investing in. So we don't know what the future is going to look like with this, but if you can wrap your head around tokenization just from a real estate standpoint, then other assets start to look pretty interesting with possibilities to do as well. Could be gold, could be silver, could be platinum. Maybe you could tokenize your car if it's completely paid off and it's worth, $15,000, and you wanted to, I don't know, get gold spinning rims on your damn car. You could sell off tokens of your car's equity in order to make that happen. Could be derivatives. The derivatives market's huge for this kind of opportunity. Videos that I do later on to show how that works, I'll be putting up as well. But think of real estate as your baseline. Think of real estate as your introduction to this concept, and then see how you can apply it in other different realms and assets. So hope this was helpful. Hope this helped clear up any confusion. Hope this was illuminating. As always, you can email me or ask questions in the comment box on the YouTube channel. And good luck, everybody. Giant hugs.